Traders. Before you start trading price action, please know these secrets about price action, and in future, you will not need any indicator at all. Number 1. Reversals usually begin with a sharp counter trend movement. Predicting when a market reversal is going to take place is the goal of many price action traders. Unfortunately, there aren't many ways to actually predict when a reversal is going to take place based on the current price action alone. Most methods involve watching for a reversal to begin upon the market reaching a price point drawn from the past, like a support or resistance level or a supply or demand zone. When the market reaches a level or a zone resistance section, traders will look for signs that suggest to them a reversal is about to begin in the market. The most common of these signs would be something like a candlestick pattern, such as a pin bar or an engulfing candle forming inside the zone or on the level itself. While these are okay to use, they don't really give you much confirmation. A reversal is going to take place mainly because they're only showing you one candlestick worth of data using engulf to actually predict, and reversals are going to occur can often be very difficult and result in many false signals. What I tend to do instead is to look for a sharp counter trend movement taking place once the market has been moving in one direction for a long duration of time. Here's an example. You can see the drop which caused the reversal, which was really sharp and was constructed or bearish large range candles that contain very little evidence of buying taking place during the down move. These are the types of movement you will often see cause large reversals to take place in the market. Of course, they don't always look like this, but they will all have the same features when they occur. Meaning multiple large range candlesticks and a few candlestick of the opposite type forming during the movement. When you see a sharp movement take place, you should mark the point where the move originated from as a supplier demand zone. Because if it has actually been created by bank traders, placing trades to make the market reverse, they'll try to get any of their additional trades placed into the market around the same point, which is the point where the sharp movement originated from. And if you see the market move into the supplier domain zone created by the sharp movement, and then you spot a common price action signal like an engulfing candle, then it's actually a good sign. The market is going to reverse and create another swing in the reversal structure. Number 2. Don't treat pin bars that form after large movements have taken place. One of the best ways to improve your success rate trading pin bars is not to create the pins which form immediately after a large movement has taken place. These pin bars have a very low probability of being successful regardless of which technical levels they have confidence with or how they are constructed. The reason why is because they mainly form due to the bank traders taking profits of their trades. If you look at the bearish pin bar in this example, you can see it forms right after a sharp move higher has taken place with buy trades. Now at a large profit, the big players obviously want to secure some of these profits. The only way they can take profits of their buy trades is if they have buy orders entering the market. This means they have to take their profits when the market is moving higher. When they take their profits, the sale orders which come into the market as a result are much bigger than the buy orders, which causes the market to fall and creates the bearish pin bar. You can see on the chart, typical price action, traders will see the pin bar and will think it's a good sign to take a short trade. When the reality is that although the pin bar may cause a slight reversal to occur, it won't be long before the market continues its up move and breaks to the height of the pin, which you can see actually ends up happening in this example. So remember this, it's not a great idea to trade the pin bars which form after a large movements have taken place. Don't get me wrong. You will often see the occasional pin bar cause the market to complete reverse after a large move. But the vast majority of them won't, at least not long enough for you to make a decent amount of profit of a trade. Number 3, stick to creating candlestick patterns which form during active market hours. My next step is to only trade candlestick patterns which form during the time the asset is actually traded, and don't take trades on patterns which form during inactive market hours. For example, if you're trading Forex, Euro-USD is traded the most between the time the London trading session begins and when the US session ends. After that, the volume drops off significantly and there are no big orders coming into the market to cause a significant move. Candlestick patterns you see formed during low activity periods have a low probability of working out successfully. In this example, I've marked on pin bars and some engulfing candles that formed during active and inactive hours on Euro USD. You can see that the pins which formed during inactive hours were clearly smaller in terms of their overall range than the pins that formed during active hours. Also, the engulfing candles offered bad signals during inactive hours. If you look at the volume at the bottom of the chart, you can see that the candle formations which formed during inactive hours had far less volume than the formations that were created during the active hours, clearly showing the lack of bank trailers' participation during their formation. Number 4. Learn to read candlestick momentum. Here are a few facts. Every candlestick you see on your chart from the 1-minute time frame up to the monthly time frame tells you a story about momentum, and every candlestick tells your story as to who was winning the battle between the bulls and the bears. Now, an increase in momentum happens when the price increases or decreases very quickly in a short period of time. Let's have a look at these two candlesticks, and let's assume that both of these candlesticks were formed in the same time frame. Let's say the 1-hour chart. Now tell me which of these candlesticks has more momentum. Is it candlestick 1 or candlestick 2? If you said candlestick 2, then you are right. Let's analyze each of these two candlesticks to really see what happened here. Candlestick 2 from opening never made a low during the early stages, which simply means that the bulls were in control of this candlestick from the opening price to the closing price. The fact that there were no candlestick wicks on either end of this candlestick is another sign that the bulls were in control from start to finish. Candlestick 1, on the other hand, after opening, it made a low, which meant that bears took control for a while. After that, the bulls took control and drove the price up all the way to the highest price, and then bears took a bit of control again by driving the price down, but not sufficient enough to have a closing price below the opening price. The fact that candlestick 1 has the same length as candlestick 2 means that they both travel the same price range in that time frame. But the fact is candlestick 1 has a shorter body length compared to the second candlestick. That's why the second candlestick represents the stronger bullish momentum. When we talk about momentum, we mean the trend's trend. For that, we must analyze candle size, the ratio between candle wigs and bodies, and the ratio between bullish and bearish candles. A few points that will help you to understand momentum. Long candles with small wicks usually signal high momentum. More bullish than bearish candles also usually signals bullish momentum, and small candles with long wicks shows indecisiveness and the lack of momentum. In this example, you can see that during the first part of the chart, the buyers were in control. Candles were mostly green and the bullish candles were much larger at the top. Things shifted with many small candles with larger wicks. After that, we started to see a change in momentum with strong bearish candles and more bearish candles than bullish candles. Number 5. Swing highs and lows that form at similar prices often lead to reversals. Analyzing string highs and lows is an important part of being a price action trader, but a little secret not a lot of traders know is that when they see multiple string highs or lows forming at similar prices to one another, it's usually a strong sign of reversal may be about to take place in the market. Here's an example of two reversals. You can see that before each of these reversals took place, multiple swing lows had formed at relatively similar prices to one another. The reason you see multiple swings form so close to one another is because the bank traders are never able to get their entire trading position placed into the market at one single price. This is because the size of the trades they're placing are so big that there aren't sell orders available in the market for them to get all of their trades executed. So what they have to do to get all of their buy trades placed is make the price swing up and down to generate sell orders, which they can use to get all of their buy trades placed at different but similar prices in the market. So the next time you see multiple swing highs or lows forming at similar prices to one another, it could be an early warning sign. The market is getting ready to reverse. You want to see the market make a shrink low or high and then shrink back in the opposite direction before creating another shrink low or high at a similar price to where the other lows or highs have formed. If you learned something new and found value, give us like to show support. Subscribe to our channel and click the bell icon to stay in touch when we upload the videos. That's it traders, I will see you in my next video.